Good afternoon, everyone. My name is Mark Dirks, and on behalf of ACRL and Choice, I'd like to welcome you to today's program, Impacts of COVID-19 and the Outlook for an Economic Recovery in 2021, Insights from the OECD, which is supported by the OECD iLibrary and the OECD Economics Directorate. Today's discussion is one in a series of webinars from ACRL and Choice that addresses new ideas, developments, and products of interest to the academic, library, and research community. Free to users, these structured 60-minute live presentations provide the opportunity for interactive discussions of important new issues and developments in academic librarianship by librarians, vendors, authors, and other interested stakeholders. Before we start up today, I would just like to point out a couple of features of the webinar software. First of all of you attendees out there who have signed in, please know that you are automatically muted and your cameras are disabled. So don't worry about generating noise or feedback or anything like that. We've got that taken care of. Also, in the main area of the screen, when the presentation starts up, you should be able to follow along with the presentation materials. And we are using the Q&A feature today. So if you have questions for either of our speakers, please drop them into that Q&A module. We recognize that our time is somewhat limited today, so we will get to as many as we have time for. So if you have questions, again, please drop them into that Q&A module. Also note that we are recording today's program and that everyone who registered should receive a follow-up email with a link to the archived version of the presentation. And as we get started, I would just take a moment to introduce our presenters. They are Patrick Linnane and Ben Westmore. Our first speaker today is Mr. Linnane. He leads a team of economists recommending better policies to the governments of Australia, Bulgaria, China, Costa Rica, Denmark, Estonia, Malaysia, Thailand, the United States, and Vietnam. He is also a co-manager of the OECD Global Forum on Productivity and organizes the periodic OECD Ministerial Summits on Productivity in Latin America and in Asia. Prior to coming to the OECD, Mr. Linnane spent 15 years at the IMF, where he served as the senior IMF resident representative in Kiev, Ukraine, and a deputy division head. He also served as senior advisor to the French Treasury and the European Commission. And our second speaker today is Mr. Ben Westmoreland. Mr. Westmoreland is currently a deputy head of division in the country studies branch of the economics department and is the head of the United States and Australia desk. He has previously been head of the Japan, Ireland, and Portugal desks in the department. Before joining the OECD, he held positions as an economist at the Reserve Bank of Australia and in the financial sector. And with that, we are ready to get started. So I will turn things over to you, Mr. Patrick Linnane.
Thank you very much, Mark. It's a great pleasure to be here today to present the new OECD Economic Outlook that was just released this morning, Paris time. So I will try to share my screen with you. Okay. So first of all, let me explain a little bit what the OECD Economic Outlook is.
Just one moment, Patrick. I'm not sure that we are seeing your screen right now.
Okay. Yes, absolutely.
There we go. Oh, we're seeing, okay. There we go.
Okay.
Excellent, thank you.
Thank you, thanks a lot. So the Economic Outlook from the OECD was released this morning in Paris time and is being presented in several places today. Let me say a few words about what the OECD Economic Outlook is. So this is done twice a year. Twice a year, we do a full set of economic projection in June and December. And in the middle of this period, we also do an interim projection in March and September. So two full sets and two interim set of projection every year. Right now, we are covering 50 countries in these economic projections, the 37 OECD member countries, the G20 countries that are not member of the OECD, plus a number of other countries. For all of these countries, we produce projection. We also write the country note describing the projection. We produce a pretty thick book, which currently is about 260 pages. In addition to these countries, we also forecast the rest of the world. So we are able to forecast world GDP and world trade. In terms of detail, we do projections for aggregate demand, public budget, inflation, the labor market, potential output. And for those who are interested, we do that in the National Account methodology in DIPA. We also run a number of alternative scenarios. We have a model called NIGEM, which is run at the NIHCR in the UK. And the Economic Outlook book also contains a number of research notes. For instance, the one which is released today contains a number of research regarding mobility during the time of confinement, the relation between the stay-at-home orders and GDP, the relation between confinement and contamination, and also research on firm insolvency. The OECD is a committee-based organization, so the projections are discussed by a number of OECD committees before publication. So I've shown here the cover page of the current Economic Outlook published today, and also the cover page of the Interim Outlook released in March. And also you will find here all the web address where you can find the book and the statistics and all the details on the OECD iLibrary, of course. Also on our webpage, the Economic Outlook December 2020. We have a website called data.oecd.org, which I personally like very much. It's very simple to use. All the statistics and all the projections are available on stats.oecd.org. And then there are a number of blogs on the OECD scope.blog where you will find a very quick summary of the projection. So today we announce some cautious good news that we see light at the end of the tunnel. The outlook is looking brighter now with that vaccines are finally in sight. Nonetheless, risks persist, and I'll say a few words about the OECD advice on what needs to be done. So there is light at the end of the tunnel, but we are not yet there totally out of the woods. After almost 1 year of pandemic, 1.5 million deaths of COVID-19 and the global recession, there's some light at the end of the tunnel. Activity has recovered in many countries during the third quarter. Several vaccines are about to be distributed for official approval. So there's hope that the pandemic will be brought under control. However, we're not out of the woods yet. There's currently a new wave of infection running in the United States and European countries. This has required new measures of restrictions, which have impaired mobility and slowed down the recovery. Restrictions have been imposed on schools, as you can see on this chart. Chart shows the restriction that have been imposed, and you see the first wave here during the springtime, relaxation of measure during the summer, and again in October and November, new restriction being introduced on schools, gatherings, and stay at home. As a result of this new confinement measures, mobility is being curtailed. This shows the Google data on the mobility for people looking for a place for retail trade and recreation. And as you can see, again, the first wave during the summertime, mobility is starting to pick up again. And now with the new wave, mobility is reducing in advanced countries, essentially. So our scenario is that the sanitary situation will be eventually brought gradually under control after the current wave. We assume that vaccines will be made available and distributed by the end of 2021. We also assume that massive support from fiscal and monetary policy will continue to be provided. With these assumptions, we project that global GDP will return to the pre-pandemic level by the end of 2021. So what you can see on this chart is our central scenario is the orange line here, and going back to the level of 2019 by the end of 2021. However, some scarring will persist in the future, even in an upside scenario. So the green line here is an upside scenario where things get better, the vaccine is distributed more rapidly, the sanitary situation gets under control, and then we have a downside scenario where confidence remains low. So what you see is that even in an upside scenario, we would remain below the blue line, which is our projection in November 2019. So it's the pre-pandemic scenario. So we expect that the global economy will recover, but there will be some scarring effect persisting, and that the world economy will remain below pre-pandemic expectation. In terms of the detailed projection, after a sharp decline this year, global GDP is projected to rise by 4.2% in 2021, followed by GDP growth globally of 3.7% in 2022. The US economy would expand by 3.2% next year in 2021, and then by 3.5% in 2022. As you can see in this table, China is avoiding a recession this year in 2020, and will have the largest economic rebound in 2021, another year of economic growth in 2022. So what you can see here is very large disparities across countries in terms of the economic performance. This chart shows where GDP would be at the end of next year compared to the level before the pandemic. As you can see, most countries would be smaller than they were before the pandemic. Just a few countries will be expanding during this period. And of course, you can see from here that China will be the country that registered the largest recovery during this period. As you can see, we expect that the US economy by the end of 2021 will be back at the level of 2019. So it's 2 years without economic growth, and then will expand again. So there are a number of risks persisting in this environment, both upside and downside risk. In terms of upside risk, we may be underestimating the rebound of consumer demand, and consumption could come back stronger if the large amount of accumulated savings during the confinement are used fully. So what you can see on this chart is the household deposits. So it's the saving that households have accumulated and put on deposit at the bank. And as you can see, in all the countries, household deposits have jumped during this period. So if the saving accumulated during the confinement are reduced more rapidly than we assume in our central scenario, growth would be stronger. However, the concentration of saving among high-income households with a lower marginal propensity to consume would limit the rebound. On the downside of the scenario, we might be underestimating the effect of a high level of corporate indebtedness and possible financial difficulties in the corporate sector. So what you can see in this chart is the level of corporate debt in percent of GDP. In 2009, so at the peak of the financial crisis 10 years ago, and the level of corporate debt in the first quarter of 2020, so when the pandemic was just started. And most countries have a level of corporate indebtedness which is identical or for some countries even higher than 10 years ago during the financial crisis. So the high level of corporate debt is a source of concern because if we are underestimating the impact of this high level of debt, and the possible wave of bankruptcies and insolvencies once the existing fiscal support is withdrawn, our projection might be over-optimistic. Let me now turn to what the OECD is recommending to countries in the current situation. So the first recommendation, obviously, is to continue to take measures to strengthen health policies in the short term in order to bring the sanitary situation under control, including the current wave of contamination that we are facing in Europe and the United States. This is not just about vaccine distribution, it's also about keeping up with good sanitary practices. In many countries, large groups of the population are still reluctant to participate in contact tracing. So what you see on the left-hand side is the share of respondents to a survey who indicate that they are not likely to participate in contact tracing. As you can see in the United States, about more than one third of respondents are either not very likely or not at all likely to participate in contact tracing. In France, where we are now, Ben and I, the reluctance is even higher. Policies to continue to gather public support in contact tracing and in general in good sanitary practices remain very important. What you can see on the right-hand side is the share of respondents who agree to get vaccinated if a COVID vaccine becomes available. And at this stage, there are a significant number of people who are not willing to get vaccinated immediately when the vaccine, or the vaccines, I should say, will become available. So that's a concern, and building up public confidence and getting people to adopt safe sanitary practices remain essential. The vaccines are not there yet. Once they are there, they need to be distributed. This will take some time, and a number of people might be reluctant to get vaccinated. So the benefit of the vaccination will take time. The second advice of the OECD is to keep up macroeconomic support to the economy in 2021, and really to continue to provide fiscal and monetary support until the recovery is well established. It's crucial to keep up this fiscal support and to target it well to the most affected sectors, firms, and workers. Monetary and fiscal policy will need to continue working in the same direction. Now, given the very high level of government spending and the rapid rise in public debt, it is essential to channel fiscal support where it will have the greatest impact. Example of well-targeted fiscal support where it will have a great impact include short-time work schemes, which have been already supported, but will need to be supported again in the future as unemployment remains high. Job retention schemes, especially for firms that are subject to confinement orders. Extended unemployment benefit to support the income of the job seekers, sick leave and childcare leave for people who are contaminated by the coronavirus, reduction or deferral of income taxes and payroll tax contribution to help those firms which see their turnover reduced dramatically. Moratoriums on rents, electricity bills, and debt payment are also important to help firms survive during this period, as well as recapitalization, loan guarantees where they are necessary. Now, of course, all this fiscal support means that all OECD countries are currently increasing their budget deficit and accumulating public debt at a very fast pace. Now, should we be worried about this fast pace of public debt increase? Well, fortunately, interest rates are very low currently in all OECD countries. So what you can see on this chart is that debt servicing costs remain low, despite the fact that between 2014 and 2020, public debt has increased a lot. The debt servicing costs are actually, in most countries, they are lower than they were in 2014. So we have a higher level of debt, but we have lower interest payments thanks to very low level of interest rates in many OECD countries. So there was some space for fiscal support. There remains space for fiscal support. So fiscal support should remain there. It should remain well targeted. Of course, the money should be well spent, but it's important to keep this fiscal support in place during the current period. The third advice of the OECD in the current period is to keep up with support to dismissed workers and job seekers. Level of unemployment remain high, but in the current situation, unemployment is not necessarily the best measure of slack in the labor market. Because people might be on job retention schemes, so they are not counted as unemployed, they are still counted as employed, but they are working with reduced working hours. So what we do on this chart here is that we are measuring the hours worked to take into account the fact that a lot of workers are under short time working schemes. So what you can see is that during the second quarter of 2020, the number of hours worked had declined dramatically, almost 25% decline in Italy and Canada, and about almost 15% decline in hours worked in the United States. Now, with the recovery and the exit from confinement, there was a pickup in hours worked. We are still well below the level of hours worked before the crisis. Another indicator of slack in the labor market is job postings. So what you can see here is the level of job posting in 6 countries, and the job posting remain depressed in those sectors that are affected by shutdowns. So the sectors that are mostly affected are professional and support services, and the sectors that are well known, such as hospitality, restaurants, hotels, leisure, education. So a lot of people are out of work, and the job posting have been reduced. So support to people remain important. In the United States, employment in sectors affected by the lockdown measures fell initially by 15 million. So what you see here on the left-hand side are the sectors that have been affected by the shutdown orders. Air transportation is not very big, but the leisure, hospitality, all the hotels and restaurants are quite significant. The retail trade sector is quite large as well. The health and social sector has also seen this number of job decline. So immediately in the second quarter, with the confinement orders, the number of jobs in these sectors declined by 15 million. Now, they recovered during the summer, but as of October, which is the latest data available, the number of jobs in the sector were still 5 million below the pre-crisis level. So it is crucial to help workers in these sectors. Now, it's important to notice that workers in these sectors are mostly workers with low skill and low paid. These are people we were able to get access to the labor market late in the cycle, as you can see here, there was a very sharp increase in jobs in these sectors. So this sector offers an opportunity for a lot of people to get back to work. However, these people with low skill and low paid, 5 million of them are now unemployed. This is a concern because they might be difficult for them to get back to work. And because they are low paid people, this run the risk of once again increasing income inequality, because we know that the best way to reduce income inequality is to give low paid and low skilled people a chance to get a job and move up to the middle class. So just to wrap up, key messages here as keep up with safe practices, wear masks, distancing, test, tracing, and isolation, plan and coordinate widespread vaccine distribution, and that includes, of course, distributing vaccine to developing countries. Avoid the premature withdrawal of fiscal support, keep easy monetary condition until the recovery is well underway, targets support to viable firms with grants and equity. What firms need now is not new debt or new loans. They will need subsidies, recapitalization, equity injections in order to rebound. One way to help SMEs is to help them digitalize. The post-COVID economy will be digital. E-commerce, teleworking will be very important for SMEs to survive. So probably one of the best ways to help SMEs is to help them digitalize. And support should be targeted to job seekers with job search assistance and training. So with that, I will stop here and I will give the floor to my colleague Ben, who will focus on the US projection. Thank you very much.
Thank you very much, Patrick. I'm just in the process of sharing my screen. I hope you can all see that fine. So, as Patrick mentioned, I'm going to talk a little bit about the US projections and the US outlook as we see it. I was thinking that I'll divide the presentation into three parts. The first, looking a little bit at how we're seeing economic developments in the US at the moment, and as we formulated the projections, how we were seeing different parts of the economy and the recovery and that process. Secondly, detail a little bit our forecasts and what we've released this morning in our economic outlook. And finally, try and nuance a little bit some of the policy recommendations that Patrick just touched upon for the US economy, and highlight what we see as being the really big priorities in the US at present. So this first chart is our, you can't do a presentation these days without having an obligatory chart looking at the virus and infection rates, etc. And so this is just highlighting the state of play of the US with regard to the COVID-19 case numbers. We know that this most recent wave kind of started in the Midwest and Northwestern parts of the country, having very high infection rates. But this figure shows that it has really broadened out now. And although we've seen a bit of a decline in the case numbers in the last week, part of that is thought to be to do with a reduced testing capacity around the Thanksgiving holiday. It might also be, though, that some of the restrictions that have now been put in place by state and local authorities, and also just some of the behavioural changes that are occurring in the economy as a result of people seeing rising infection rates, are resulting in better sanitary practices, more physical distancing, that are seeing some sort of plateauing in these indicators. We, along with many other economists, were kind of in a position at the start of this pandemic whereby we had a rapidly evolving economic situation, and we had a bunch of hard and soft economic indicators that we typically relied upon that weren't going to be released for some months. And As a result of that, we've kind of had to redesign our systems to look more at high frequency data, some of the kind of very high frequency daily, weekly, fortnightly data that gets released, and try and develop new models to try and model the economy using these new sources of data. And so these figures here just show one of these such indicators, which is our weekly GDP tracker, which uses data from Google Trends that becomes available on a weekly basis. And so on the left-hand side figure here, we have the weekly tracker, which is the blue line, and then the red dots are the outturns for actual GDP growth that are reported for the US by the Bureau of Economic Analysis. So so it shows that our tracker does a reasonably good job of tracking the actual outturns. But what I'm kind of most interested in is kind of zooming in on this period, which is the periods from the beginning of the pandemic, or the outset of the pandemic. And that's on the right-hand side chart here. And what you can see is that there was a big hit to economic activity at the onset, and then through the summer months, there was a gradual recovery in economic activity that was pretty steady and pretty stable. This chart is updated until mid-November, and you can just see that in those first couple of weeks of mid-November, activity started to weaken somewhat. And to some extent, that's consistent with the rise in case counts that I've already shown, but also to do with more strict containment measures. And in the green bars, there is the University of Oxford Containment Stringency Index. Just taking a bit of a step back though from those high frequency indicators and looking at the pattern of the pandemic in terms of the economic impacts and the recovery. One of the big themes that we've been seeing across countries, and it's the case in the US, is a great deal of heterogeneity in terms of the impacts. We're talking about differences in the extent to which different industries have been impacted, into which different firm sizes and different types of firms have been impacted, and different worker cohorts. And this can be shown a little bit when you look at the consumption data in the US, and highlights that goods consumption has recovered relatively swiftly. And this is especially the case for durable goods. So these are things like motor vehicle sales and recreational goods that have really bounced back heavily. And partly this may be to do with those very high saving rates that were observed through the worst of the pandemic period back in April and May. Services activity, though, remains somewhat impaired, and you can see that here on the grey line, that services consumption is still some way below where it was in the pre-pandemic period. And if we look at Google mobility reports, we see that activity in the US at the moment in kind of restaurants and bars and theatres is about a quarter below where it was at the end of 2019. And so really services activity is the part of the economy whereby most of the impacts are still being felt and the recovery has been the slowest. Some of the recent labour market data, as Patrick also emphasised, has been positive. There have been big improvements. We're not just looking at the heavily impacted sectors, but the economy as a whole. About 22 million jobs were lost off employer payrolls between in March and April. About a bit over half of those have now been added back. But another way to think about that is that there's still about 10 million people that have lost their jobs as a result of the pandemic, or since the pandemic began, that are still out of work. And so with the passage of time, what you're seeing is measures of long-term unemployment, and this is one of them in the green line here, are starting to rise. And so that's kind of underscoring the potential scarring effects of long-term unemployment and highlighting some of the effects that may have going forward. A lot of the industries that have been impacted, as Patrick said, are characterised by a relatively high proportion of low-wage workers, in many cases a relatively high proportion of low-skilled workers. And so you can see on the left-hand side here is just the percentage change in employment by different wage cohorts, and it really has been those low-wage workers that firstly saw the biggest hit, but also that haven't seen as much of a recovery, especially over the last 6 months in terms of employment. On the right-hand side here, it just shows, there are particular cohorts as well when you look at employment to population ratios that have been heavily impacted or remain heavily impacted. And here we highlight the Hispanic or Latino and Black or African American communities as being particularly hard hit in terms of the reduced employment to population ratio. It's not all, it hasn't all been kind of depressing news though. There has been some bright spots, and one of those in the US has been the housing market. There has been a relatively rapid recovery in housing starts, housing permits, housing construction. That is partly to do with some pent-up demands that was inhibited from being activated in the first early stages of the year when the pandemic was going on and there were stricter lockdowns. But also mortgage interest rates have come down at relatively low levels. And a lot of that has to do with government's policy action, so both on the fiscal side and in terms of monetary policy accommodation, that has meant that financial conditions, after a kind of tightening in financial conditions when there was a lot of financial market turmoil, especially in the second half of March, have come back to be a more accommodative or more supportive of investment in the housing sector. When we look at business investment, it has been a little bit weaker. When we look at machinery and equipment, there has been a recovery in activity, but it still hasn't recovered its pre-pandemic levels, other than which kind of contrasts to what we're seeing in dwelling investment there. And that partly reflects, some of the uncertainty that remains with regard to the future trajectory of the virus, with regard to developments around the vaccine and when economies will get back to normal. Investment in buildings and structures by businesses has been particularly weak. That's partly got to do with the oil sector and lower oil prices disincentivising new investment in drilling capacity. But it also kind of reflects what's going on with the pandemic. And we know that investment in commercial real estate, in kind of central business districts, etc., and in tourism type structures and buildings has also been weak. And so that has been one of the reasons why we really haven't seen any recovery in the building and structures investment so far. In the US, fiscal policy responded very appropriately with the CARES Act in terms of the timing and the scale of it and the composition. We think that it was appropriate for the size of the shock that the economy was experiencing. The US is like these other economies that Patrick highlighted as one that's going to see a big rise in debt over the coming years. In terms of our projections, we have it at over 20% of GDP between 2019 and 2022 in terms of the increase. But we would put the US in the box where we would recommend, thinking about the sustainability of public finances and making sure that fiscal spending is well designed and has the biggest impact possible, but being sure not to scale back or unwind the support too prematurely, which could endanger the recovery. So if I just turn to our forecasts now, it's clear that there is a lot of uncertainty at present for economic forecasters, and our numbers that we released today are predicated on a number of assumptions that may be different to other institutions or others may have different views about. Firstly, and one that's specific to the US, is with regards to a fiscal package. We have assumed in the forecast that a package is agreed upon and legislated in the first half of 2021, and what I'm talking about here is an additional fiscal package on top of the CARES Act measures. And this additional package would be worth about 6% of GDP, so it's about half the size of the CARES Act, and would mostly take effect through the second half of 2021 and into 2022. We do think that such a fiscal package is important at the current juncture in order to support the recovery, which we see in the US as still being in its relatively early stages. In terms of the composition of that package, financial assistance to state and local authorities would be one area that we think is important, given that their tax receipts have been heavily impacted by the pandemic and especially a reduced activity in kind of consumption-related activities and tourism, and also balanced budget constraints that mean that many of these authorities may have to scale back vital spending going forward. So that's a kind of policy recommendation that we have for the US. We also have some other assumptions that are more common across OECD countries, but these are also applicable to the US scenario. We have an expectation in the projections that there will be continued virus outbreaks, but these will be relatively localized. They'll be accompanied by containment measures at a local level, but we won't see national lockdowns until a vaccine is deployed. And in terms of that deployment of a vaccine, the assumption in our projections is that we see widespread deployment in the second half of 2021. So these are our US forecasts, and they're in calendar year terms. We have for 2020 GDP growth at negative 3.7%, before GDP rises by 3.2% in 2021 and 3.5% in 2022. In terms of kind of how this plays out with regard to the quarterly profile, the fiscal assumption that I just mentioned looms large. We really have a lot of the activity in the second half of 2021 and moving into 2022 as a result of that fiscal package being agreed upon and there being a strong fiscal impulse through those quarters. We have some expectations around export market activity as well. When we look at export growth, we're expecting that to recover gradually through the forecasts. That partly reflects a recovery in major trading partner growth with the US as major export partners. But we also expect, when we're thinking about the phase one trade deal between China and the US, that some of the quotas around that are more closely adhered to in 2021 and 2022. And so the US may gain a little bit of market share in terms of exports. If I focus for just a minute on our labour market projections, we are expecting the labour force participation rate to continue to improve, that is to increase over the forecast horizon, but we don't expect it to reach those pre-pandemic levels. And that's partly to do with some older workers that are choosing to retire rather than to find another job in a difficult labour market or to move jobs in this current environment. Also, with the unemployment rate, we see some decline in the unemployment rate and some improvement in labour market conditions throughout the forecasts, but we don't see the kind of lows that were plumbed in that pre-pandemic period being achieved again before the end of 2022. And what that means is that there'll continue to be labour market slack, that wage pressures will be relatively subdued, and so we don't expect price inflation to get to the Federal Reserve's 2% target by the end of these projections. And so we expect monetary policy settings to be very accommodative at the end of 2022. So as with the global scenario or projections with the US, there are obviously risks both to the upside and downside. You can make plausible cases for there being upside or downside risks with regard to the fiscal assumption. We will obviously know more and have a better sense about what the likely fiscal developments will be when we have a sense about the composition of Congress. But you could make a case for an upside scenario whereby a much bigger infrastructure package is put in place in 2021 and is legislated than what we currently have in our projections. But similarly, you could also say that it may take many more months than we're assuming for a fiscal package to be agreed upon, or that it's smaller in scale than what we currently have factored into our forecast, and that would be a downside risk to our growth projections going forward. With regard to the virus, a lot of the developments around a vaccine recently have been quite positive and have surprised on the upside. It could be that there's a good chunk of the US population that are vaccinated in the first half of 2021, and that could provide an upside risk to growth. On the other side of things, we could start to see this kind of elevated virus infection rates that we've recently seen in the US continuing to rise, and that leading to new containment measures and a reduction in economic activity that compounds the impacts that a lot of these sectors that have been most exposed to the COVID risks have felt. And so we might see a bigger wave in that sort of scenario. We might see a bigger wave in business insolvencies that would dent investment prospects. And this is also something Patrick touched upon a little bit with regard to the global situation, but in the US, it is certainly true that we've seen a kind of what we would say is a worrying rise in corporate leverage and in corporate debt being taken on by businesses, and especially in some of these sectors that have been heavily hit. We know some of that has been just building up cash buffers and using some of these grants and new programs to do that. But if you look at corporate net debt, so you take those cash buffers out of it, it still has increased quite a bit. And so when you think about the resilience of the economy to future shocks, both in the short term and the medium term, these sort of increase in debt may also pose downside. Finally, I'll just cover off on the policy priorities that we've highlighted for the US. The crisis at the moment is first and foremost a health crisis, and public health systems need to continue to be supported and buttressed. In the US, the health spending efficiency still has scope for being improved. And so when we're thinking about channeling more resources to the health system, making sure that those are being implemented in a way that gets the greatest bang for buck and really has the best health outcomes is important. And then in terms of the vaccine and administering the vaccine, ensuring that there is transparency and kind of a well thought out process about how that happens, both the manufacturing and the deployment, to engender confidence within the population to take up the vaccine will be important in terms of getting us back to some sort of state of normal sooner rather than later. On the second one, with regard to supporting labour market transitions, there's still a kind of debate going on as to the extent to which this is a reallocation shock, or so whether the economy, once we come out the other side of this crisis, will look a lot different to what it did when we entered it, or whether once we have a vaccine, once it's administered, this kind of structure of the economy will look very similar. And so in that sort of scenario, we don't need a lot of different sort of reallocation across sectors, because the sectors that have been shut down are going to be temporarily shut down and won't permanently contract. But it's true, and as we've emphasised, that there are still a lot of people that are out of work. And so trying to help them move back into employment and ensure that they don't get disincentivised and discouraged and leave the labour market will be important. And in that context, job placement services and retraining programs are especially necessary. We also see there being scope to rationalise some of the regulatory measures that maybe inhibits labour mobility. So coming out of this crisis, we want to support the recovery by allowing workers to move to those areas and those positions where they see that they have the highest potential and where there is the highest growth potential in the economy. But some regulatory restrictions, and specifically I'm talking about things like differences in occupational licensing across states and things like non-compete agreements in work contracts, which reduce the mobility of workers to take up new good opportunities that might pay higher wages, are impeding both the ability of resources to move and also workers to take advantage of those opportunities and to boost incomes as a result. And then also, the last two here is when we're thinking about recovery plans, keeping in mind some of the long-term objectives that the US needs to work towards. Continuing to improve public infrastructure will be necessary. And so when you're thinking about fiscal packages, ensuring that those infrastructure programs that are being put in place are well designed, good cost benefit analysis are being done. And it doesn't just need to be public infrastructure. It may also be that you put in place better kind of user fee systems to ensure that more of the costs of using this infrastructure are internalised by the users. And that may also help with the planning in terms of highlighting where capacity is needed within the system. Finally, another objective in terms of recovery should continue to be decarbonising the economy. A first step should be withdrawing the subsidies for fossil fuels while ensuring that the energy system and energy supply is still secure and safe and reliable going forward. So I'll finish there.
Excellent. Thank you so much, Ben and Patrick. This is Mark from ACRL and Choice. Looking through the questions that we've already got in the hopper, we've got several ready to go. And I would just encourage folks out there, if you do have questions for either Ben or Patrick, please drop those in the Q&A module. And if you could do me the favor of addressing it to either one of the speakers, that would make things a little bit simpler. But what we've got right now is, and I think this came through, Patrick, during your presentation, a question from Carlos who asks, could you please elaborate on the extent of the fiscal support? What about the public debt constraint? When do you expect fiscal consolidation to begin?
Yeah, thank you very much, Mark, and thank you, Carlos, for the question. That's a question that is asked a lot these days. I mean, the numbers that are put on the table are so big, right? We're talking of billions or trillions of dollars. So for the OECD in general, the amount of fiscal support that we have estimated is about 9% of GDP. So you think of a fiscal stimulus of 9% of GDP on average in the OECD. That's a very big number. I have to say that it will take some time to assess exactly the size of this number. There are a lot of programs that have been open and created. Some of these programs have a low take-up. They are available, people don't use them. So it will take some time to finalize the assessment, but the amount of fiscal support by 9%. Really the message here and what we assume in our projection is that this fiscal support is withdrawn very gradually, very slowly. So suddenly 2021 is not it's too soon to withdraw fiscal support. So certainly for the US, we assume in our projection that there will be a second stimulus package. And I think Carlos is right that we have to keep in mind that this money is borrowed, so it's debt piling up. So important that government use this money well. Larry Summers 10 years ago, he talked about the 3 T's, timely, targeted, and temporary. I think these 3 T's from Larry Summers remain relevant. So suddenly directing support to job seekers in need of income support is very important. Helping firms avoid insolvency, bankruptcy if they are viable, that's very important as well. Now, like I said, at this stage, debt has increased a lot. We are not worried, and it looks like financial markets are not worried. If you look at very low interest rate on the financial market. So again, very low interest rate means that debt is high, but interest payment is low, right? So I think it's very important that this coordination between central bank and treasuries. So central banks are keeping interest rate low, and that make debt easier to service.
Excellent. All right, we've got several questions here, and I would jump perhaps down to Aranta's question that says, public health measures appeared first in your list, but in the public stage, economy and health have been presented, or perhaps on the public stage, have been presented as antagonists, particularly in some countries. Is it possible to make a stronger message from the economic actors in favor of public health measures, like the ones described, in order to not only protect health, but also to recover the economy? So how do those two interact, the economy and public health messages, I think?
Yeah, I can. Thanks for that. I think that's a very good question as well. I can say a few words, and I'm going to look east. Well, at least for France. Look to Asia. For you, I'm not sure if it's west or east, but as you saw in our table, the strongest recoveries are in the Asia Pacific region. So China was able to stop the epidemics very quickly, and they have a strong recovery. Now, you're going to tell me not everybody can do like China, right, or Vietnam. But Australia and New Zealand have been able also to stop the epidemic pretty quickly. And then they can, start the recovery very fast. Moving quickly. So in the book, and this is available on our website as well, we make a differentiation between containment policies, and containment are very bad for the economy, of course, and health policies. So everything that is related to testing, tracing, isolating, help to bring the epidemic under control, but has little economic impact. Restricting visit to care homes as well. A lot of people died there, unfortunately. Doesn't cost much to the economy. It's very good to bring the economy under control. Now, mask wearing, I know this is controversial in many US states. Now, when we go in the street in Paris, we have to wear a mask. That's also a good way, to stop the virus circulating. I have to say schools is also quite important, allowing little kids to go back to school in safe situation. This is important because then the parents, and I saw that Carmen had a question about movers, parents and, movers and fathers as well, little kids going back to school, then the parents can go back to work. Even teleworking, when you have to look after your little children at home, is very difficult, right? So I think this trade-off is not really a trade-off. There's a smart health policy that contains the virus, and is not too harmful to the economy.
Excellent. And did you have anything, Ben, that you would like to add to that? No? All right. Great. So I think perhaps this came up during your presentation, Ben. A question here from Bennett, who asks, would a reasonable assumption be that spending has shifted from services to durable goods? Instead of going to a restaurant, for example, people are buying a really fine bicycle. Is that what you're seeing?
Yeah, that's right. I think that's a reasonable assumption, and also speaks a little bit to one of the other questions on the chat from Peter Richards, just in terms of what has kind of surprised us with regards to the recovery so far. And I think in the US and in a lot of countries, the bounce back in consumption activity, especially consumption of some of these durable goods, has been quite surprisingly strong. And that has been, a lot of that has been a reorientation of spending away from, as you said, services to more durable consumption goods. The question now is, though, and when we're thinking about the recovery period, is whether that sort of activity is sort of done its dash. I mean, once you've got a new kind of fancy bike, you presumably don't need another one. And so what we've seen in the last 3 or 4 months is a lot of that kind of reorientation and this big boost in durable consumption activity. But that is kind of been bringing forward activity from next year and the year after that would have occurred anyway, just because of the circumstances under which people find themselves. And so I think that's one thing that we're grappling with at the moment, is there has been this reorientation. Is it a kind of a step increase, and now the pace of consumption in these areas will just continue the way it would have otherwise? Or is there some kind of intertemporal shifting of activity from future periods that mean that it might actually, we might actually see some weaker growth in some of these non-service related consumption activities going forward?
Very interesting. And perhaps to stick, as you mentioned with Peter's question there, he did put that to both speakers. And Peter has sort of said, what do you see as the greatest dangers to the economic recovery going forward? Have you, and to speak to what you were, have you been surprised or dismayed by the pace of recovery to date? Would you be able to speak to that, Patrick?
Yes, I'm happy to, but Ben would like to add a few words as well. So I think the greatest danger to the recovery is the lack of government support. And that's why today the OECD has been very vocal in saying, you know, let's not repeat the mistakes done 10 years ago after the financial crisis, when fiscal support, you know, was withdrawn too quickly. And therefore, you know, the recovery from the financial crisis took a very long time. You know, we look at the numbers, it took 10 years for the US unemployment rate to return to the, you know, lowest point before the global financial, 10 years, so very long. You know, let's not repeat the mistakes. And again, the greatest danger is the lack of government support, you know, premature withdrawal of fiscal support. We're also worried, like I say, about corporate indebtedness, very high level of debt. We don't foresee that this will spill over to the banking system. You know, the banks came into this epidemic in relatively good shape. The banks were well capitalized. So we are, you know, not worried that corporate debt will translate into a banking crisis. But, you know, this is certainly something to watch. And that's why we say, you know, maybe the best way to help companies, especially SMEs now, is not to lend more money. It's really, you know, defer taxes, you know, let them defer the rent payments. It's not, you know, and also, you know, maybe equity injection, you know, debt equity swaps. You know, it's reduce the leverage of the corporate sector. You know, of maybe less debt and more equity to avoid, you know, a wave of bankruptcy coming eventually. Ben, you want to add something?
Yeah, I mean, I can follow. No, I completely agree with Patrick there. I mean, I think the number one thing is in a lot of countries, and the US is the same, is prematurely withdrawing fiscal support at a time where it's still really critical, especially with a lot of people that continue to be unemployed and a lot of businesses that are being constrained by the measures that are put in place. I think the other thing that I would add, though, as well, is just on the health front. I mean, if you, the kind of developments with the virus is still very important with regard to how this economic recovery goes. And then, you know, there's not, I mean, developing a vaccine was the kind of first step in the process of getting ourselves out of this. But it is a lot about, you know, manufacturing and distributing the vaccine in a way that engenders confidence within the population to go and get it administered. If you continue to have, you know, adverse virus impacts or problems with the vaccine process that had an impact on uncertainty and it resulted in particular sectors of the economy continuing to be constrained in their activities, then that sort of thing and those health developments could actually compound some of the fragilities that Patrick's just talked about with regard to corporate debt, etc. And you could get into a very weak recovery type scenario when some of those things kind of are stacked upon one another.
Excellent. And I want to be mindful of the time. I know we have gone just a little over already, and I know in Paris it is getting late. Would it be all right to take just one more question here as we wrap things up? All right, great. Looking at the questions that we've got lots of great questions. And as I said, unfortunately, we don't have time to get to all of them. Perhaps maybe we take a question sort of looking abroad a little bit. We've got a question here from Sachin, and I apologize if I'm mispronouncing your name. Is there something the world can learn from the figures that you showed, Patrick, about China's growth rate? Is there something there that can translate to the US and to other countries as well?
Yeah, that's a good and tricky question. You know, can the US learn anything from China? I think these are different culture, you know, different political realities. You know, I think China has been able to introduce very rapidly, you know, stay-at-home orders. China was able to test everybody, you know, every single person in a city when there was a risk of a cluster appearing. You know, it's part of the Chinese reality. Can it be done somewhere else? Can it be done in the US? You know, probably not very easily. It's not only China, actually. It's interesting that if you look at our numbers, the Nordic countries, Scandinavian countries, you know, in Sweden had a different approach. But you know, the economic growth there, the recovery in Sweden is pretty strong. Norway as well. You know, Germany. You know, there's a culture of being very careful, wearing masks, staying at home. You know, there are government lockdown, but there are also self lockdowns. You know, when people from their own behavior, they decide, but they have to be very cautious, you know, and wear a mask and avoid large gathering. You know, wash your hand, you know, keep a distance. And in fact, you know, by using this self-lockdown and very careful behavior, you know, they have been able to limit the damage to the economy and recover. So can the US learn something from China? I don't know. Maybe you can learn something from Nordic country or Germany, you know, where, you know, even if the government, you know, does not impose orders, you know, we all have to be careful, you know, just not only for ourselves, also for our families and our friends.
Excellent, yeah. And I would just ask Ben if you have anything else to add to that? No? All right. Then I think we will leave it there. And I will just take a moment to say thank you so much, Patrick and Ben, for the really insightful, fascinating presentations. And as we sign out, I would just remind folks that we, of course, recorded the program. So please be on the lookout for that follow-up email. If you have a few minutes after the presentation, as you sign out here, you should be directed to a brief survey. If you could take just a couple of minutes to give us a little bit of feedback, we would really appreciate that. Also, please do visit the COVID-19 and policy tracker hubs at www.oecd.org/coronavirus/EN, as well as the OECD iLibrary.org, data.oecd.org, and stats.oecd.org. If you have other questions, and if you're looking for additional information, you can reach out to Ian Williamson, that's IAIN, and then Williamson with 2 L's at OECD.org. Thanks again to all of you out there for joining us today. I, of course, hope you learned a bit, and we hope to see you in the near future on another webinar. Thanks very much.